Over to you, Roshni. The broadcast has started.
Okay, good evening, everyone. So welcome to the second session of our program on tax landscape in Sri Lanka. So today's topic is going to be on tax on dividend. So I have with me Jivanti, one of my colleagues, who will be assisting as well in delivery of this program. So to start with, why we decided to speak on tax on dividends separately or as a specific sort of topic is a couple of reasons. Firstly, it's the definition, where we will look at the definition. It was changed with effective from April 1st, 2018 with the introduction of the income tax law. Second is because there was abolishment of the withholding tax from January 1st, 2020. So how the tax on dividends changed with that date. Then also identifying exemptions, that was also changed with effective from January 1st. And also how you look at the implications for the distributing company, the shareholder, etc. also is important. So that's why we decided we'll take a separate topic on tax on dividends. So that's it as a sort of like a background. So today's agenda will cover the definition. As I said, we'll take a look at it from the Inland Revenue Act. Then we will also look at the dividend income and the redistribution, how it happens. We will also look at how the exempt amounts of dividends are derived and what does the law say. Are there any specific dividend exemptions on dividends? And also finally, to conclude, we will do like a wrap-up summary of the tax implications. So just to inform the audience, we will be having like short breaks in between so that we can take questions relevant to the areas that we have covered. Next slide, do you want to? Yeah, so we'll look at the definition, what is in the income tax law. So a dividend, Jivanti, can you sort of shift the sorry, can you, is it on full? Is it on full mode?
Yeah, yes,
Okay.
Roshni.
So the definition which is given in the Inland Revenue Act is a dividend is defined to mean a payment derived by a member from a company whether received as a division of profits. I cannot see that. Whether received as a division of profits in the course of a liquidation or reconstruction in a reduction of capital or share buyback or otherwise. Includes the capitalization of profits, whether by way of a bonus, share issue, increase in the amount paid up by shares or otherwise, and whether an amount is distributed or not, and excludes a payment to the extent to which it is matched by a payment made by the member to the company, debited to a capital, share premium or similar account, or otherwise constitutes a final withholding payment or is included in calculating the income of the member. So as you can see, the definition is very broad and is different to what you and I would understand what a dividend would be in terms of the Companies Act, which is simply distribution of profits. So this definition in the income tax law also captures different sort of scenarios how a dividend could arise for income tax purposes. So we will sort of go and sort of examine this a little further later on, and also give you how to identify different scenarios where a dividend is received and how a dividend is paid and what the tax implications are. And also like I said, the taxing of dividends changed effective from January 1st because of the abolishment of withholding. So the taxation to the shareholder is if it is distributed by a resident company, it will be taxed at the company shareholder level. not when they're distributing. And if it is distributed by a non-resident company, it will be included in calculating the income of the shareholders. We will, once we sort of go into sort of detail, we will sort of explain what these mean, how the shareholders or how the taxation to the shareholders occur when dividends are distributed in various forms. Okay, so that's just basically a very sort of introduction as to the definition. Once Jivanti sort of explains, we will conclude and sort of see what the differences are. So Jivanti, over to you.
Thank you, Roshini, and very good evening to everyone. So, since Roshini has given a kick start to the session with the definition of the dividend, so I'm sure you may have realized that the dividend is not the same as we think. So, in general terms, we all are in the view that it is a return you get on the investment in shares, but for tax purposes in Sri Lanka, it has some further inclusions. So I hope you agree with me. Since Roshini has well explained the inclusions and exclusions of the definition and the dividend, let's further discuss the tax implication of dividend. So for tax purposes, dividend should be analyzed in two ways. One aspect is to consider as the income received by the company or the shareholder, and the other aspect is to consider as a dividend payment. So we generally call this dividend payment as a dividend distribution. So, okay, right. The question is why we should look at dividends in these two perspectives for tax purposes. That is because we require to quantify the amount of tax expense or the tax cost we have on the dividend income received by the company or an individual, and on the other hand, the obligation towards shareholders on the dividend payment, that is at the time of distribution. So those are the two main categories we are planning to discuss throughout the session, and also the possible ways of minimizing the tax cost by applying the specific exemptions granted in the tax law. Okay, right. So when a company is proposed to declare a dividend, that company can either use their own profits and income for such distribution, or else they can distribute out of the dividend income received. We generally call this as a pass-through distribution. So, and on the other hand, when such dividend income is received by another company or an individual, I'm referring here the recipient of such distribution, they have dividend income in their books, which was distributed by the previous company using their own profits and income, and distributed out of dividend income they have already received. That is, dividend income received via pass-through distribution of the previous company. So it's very important to understand these two scenarios, because when there is a dividend distribution, such dividend distribution will become the dividend income of the recipient. And the method used by the company which the dividend distribution was made is required for the recipient to compute the tax exposure on such income. So basically, it is interconnected, right? So I'm planning to work on some illustrations throughout the session so that you will understand this concept. Right, okay. So, so let's discuss the two perspectives in detail. Let's first look at the income perspective. So that is the dividend income received by the company or the individual. So as I mentioned earlier, dividend is distributed based on two methods. That is out of the profits and income of such company, or else out of dividend income received by such company. So for the purpose of analyzing the dividend component, we have to perform kind of an analysis to identify what is the liable dividend component and what is not liable or the exempt. Okay, so in order to draw this conclusion, we have something similar to a kind of a checklist. Okay, for the explanation purposes, I'm using this graph so that you could have a clear understanding on these analysis. Right. So the very first criteria is to identify the residency status of the company which such dividend is declared. The question is why residency status is important in our analysis. That is because based on the residency status, part of such dividend income may exempt from income tax. Based on the provisions of the tax law prevailing in Sri Lanka, the dividend received from a non-resident person is not liable for taxes. So we will look at the exemptions in detail later. So the first step would be to identify the residency status of the company which such dividend is declared, right? So then we have decided the dividend received from a non-resident company as exempt in this graph. Now we are leaving with the dividend component received from a resident company. Okay, so then we need to find out whether such resident company is a BOI company or a non-BOI company. So if I explain you further, the BOI company is a company which generally gets tax exemptions or tax holidays based on the investment criteria, right? So subject to the conditions given in the agreement, the profits or income of such company generally exempt for a certain period. That depends on the provisions in the agreement. So if those companies are still enjoying the tax exemption period as per the transitional gazette, in the transitional gazette, it specifically allows a BOI company to consider the exemptions under the prevailing tax regulations. So then the dividend declared out of such profits are not taxable. So in that case, we can eliminate the BOI company from our checklist as exempt, and our test is further required on the dividend income received from a non-BOI company. So if the dividend declarant is a non-BOI company means no tax holidays, they don't enjoy any tax exemptions under the BOI. So the profits are generally subject to taxes within the prevailing tax regulation. So then the next step is to find out what is the distribution method they use to declare such dividend, whether it is declared out of their own profits and income or declare out of dividend receipt. So that is a pass-through distribution. Okay. So if the dividend is declared out of their own profits, then such component is taxable in the hands of recipient, subject to the specific exemptions given in the Act. But if such dividend has been declared out of dividend received, so that is a pass-through dividend, that dividend is exempt in the hands of the recipient based on the principle that it has already been taxed. But there is an important milestone we have to highlight, that is, as Roshni said, that is the Sri Lankan government has proposed to abolish the withholding system effective from January 1st, 2020. And because of this change, there is no withholding mechanism after January 1st, 2020 on certain payments, which includes dividends as well. So in line with the same, we are required to break this component into further subunits as dividend declared prior to January 2020 and dividend declared after January 1st, 2020. So whatever the distribution made prior to January 1st, 2020 was subject to withholding tax, and based on that, there won't be any further taxes on such dividend income. But the distribution made after January 1st, 2020, we'll have to analyze carefully. We will do an illustration to explain this component later. Okay. So based on these analyses, you'll be able to identify each dividend component separately and decide what is liable component and what is the component which we can consider applying the respective exemption. Right. So I know now the next question is, you all must be having this question: how the shareholder gets all these details. So when a company is making a dividend distribution, that company should provide the dividend warrant to the recipient. It is the mandatory requirement So provide such, and it has a specified format to disclose the details of the dividend distribution to each shareholder. So when there's a distribution by the company, they should provide a dividend warrant specifying what is the method of the distribution, like that is whether such dividend is declared out of liable profit or exempt profit, or whether it is declared out of dividends. So those things have to mention in the dividend warrant. So the dividend warrant is a key document to decide the tax implication of the dividend income of the recipient, as well as the dividend warrant is a mandatory document for recording purposes as well. So right, so are we clear up to this point? Any comments or questions? I'm ready to take questions, but if you have any questions with regard to exemptions, we can take those questions later, as I'll be taking you all through the exemptions in my subsequent slides. I can give 2-3 minutes to take questions.
From Hasnan Mahmood, he wants to know what is a BOI company.
Sorry, I didn't get it.
There's a question from Hasnan Mahmood. He wants to know what
Okay.
is a BOI company.
What is a BOI company? Okay, right. Since we have participants from various countries, I will explain what is a BOI company.
Yes.
It's a company which they have, they have entered into an agreement with the Board of Investment of Sri Lanka, right? And in general, such companies get a lot of concessions in terms of investment, the taxes. So if a company is subject to provisions of the BOI, including the tax concession, then the most likely the profits and income is exempt from income tax for a certain period, right? So this is BOI company is a company which they have entered into an agreement with the Board of Investment of Sri Lanka. Is that clear?
So just to elaborate on that, so the BOI was set up to enhance foreign direct investment. So any FDI to the country has to be routed through the Board of Investment. So depending on the size of the investment, there will be concessions in terms of income tax, customs duty, and so forth. But the regulations sort of changed recently. Any income tax exemption is now referred to in the income tax law. But there are other concessions in addition to taxes. They get concessions in terms of visa and etc. So basically, it's the regulatory body that governs FDIs into Sri Lanka, in summary. I hope that's clear.
Yes, Devanti. I think we can move on for now.
Okay, right. Let's continue with the rest then. Okay, we will start the next chapter then. In this section, we will discuss how we should determine the exempt component of the dividend based on the several important exemptions given in the law. So let's work on few illustrations as well, so that you will have a better understanding on the concept up to now. So when we were discussing the pass-through dividend component, here, right? I know it's a bit of a confusing point, as it has some different implications to both the recipient as well as the company, which such dividend is distributed. So you will have to focus on both sides to understand this concept, right? So okay, so the law provides the exemption for the dividend income which was received by the company via the pass-through distribution. So this is the exemption applicable for the dividends distributed after January 1st, 2020. And there are a few terms we need to focus on. I read out the section for you. It says a dividend paid on or after January 1st, 2020 by a resident company to a member to the extent that dividend payment is attributable to or derived from gain and profits from dividend received by that resident company is exempt from income tax, right? So if you can see, the exemption is specifically refers to a resident company or the individual, right? So that is because the law provides a specific exemption to the dividend income received from a non-resident person. So this exemption refers only the resident company. So, and then what do you mean by gains and profits here? Okay, the, the, the Inland Revenue Act specifically defined the term gains and profits to include the dividend received by that company after the deduction of expenses or losses, if any, subject to the provisions of IRA and income tax paid or payable on such dividends received by that company. So, in general circumstances, we all know what constitutes the profit. Profit equal to income less any attributable expenses. So, the similar theory is applicable here also. In order to arrive the gains and profits from dividend income, the company is required to identify the expenses attributable in earning such income. Okay, so and it further required to identify the applicable tax payment on such profit to claim the exemption. Okay, so let's take these illustrations to understand how we should apply the term gains and profits in the instance where a company receives the dividend income as well as redistribute dividend by using the same pass-through distribution. Okay, so in this, I hope you can see my illustration properly. So in this illustration, we have company A who's planning to do a dividend distribution exclusively out of their profits, right? So they're using only one method. So they have decided that they should distribute a dividend of rupees 1,200 out of their profits to company B, right? So the company B, as the recipient of this transaction, they have recorded rupees 1,200 as the dividend income in their books, right? So now it's company B has to determine what is their tax cost on this income of rupees 1,200. So the Inland Revenue Act provides the 14% tax rate on dividends received by the companies and progressive tax rate for individuals. In this case, we are referring to a company, so the applicable tax expense on dividend income should be computed by applying 14% rate. Okay, so in this scenario, the company B is also the first step is that. So this as a second step, now the company B is also thinking of distributing dividends to the company C by utilizing the dividends income received by company A. Okay, so on this matter, I have a question. Can company B distribute the entire rupees 1,200 to company C as dividend? Can company B distribute the entire thing to company C, which they have received from the company A? To answer this question, first we need to identify the distribution method of company B. So since they are using the dividend income distributed by company A, it will become a pass-through distribution. That is clear, right? So that will definitely become a pass-through distribution. Okay. So should it be exempt in the hands of company C? It should, because they should be able to apply the exemption because for them it is a dividend income which was declared by company B using the dividend income received by them, and again which was earned through company A. Okay, so it will satisfy the conditions given in the act to claim the exemption provided in the law. So once decide the possibility of applying the exemption, then again we need to quantify the exempt amount as required in the section, as it specifically refers to the gains and profits which should be subject to the expenses or losses and the tax payable on such income. So if I go back to the illustration, it is clear that the company B has to pay tax on their dividend income they receive from company A, as it was not subject to taxes, right? So they got the gross amount of dividend from company A. Company A has not deducted anything, so the company B has to pay tax on that. Then, but at the same time, the company B need to quantify the amount they should distribute to company C as well. So as required in this section, company B has to quantify the gains and profits of such dividend income of rupees 1,200 before this pass-through distribution. Okay, so in this case, suppose the company B has identified rupees 200 as their expense to earn such dividend. So the first step should be they need to calculate the gain from such income. So what they have to do is they have to deduct the expense of rupees 200 from the gross dividend of 1,200 and arrive the gain and profit of such dividend, that is 1,000, and then compute the tax liability of such gain by applying the rate of 14%. You can see my working here in the slide. And so after the deduction of expenses and the tax payable on such income, the company B can distribute only 800 rupees 860 to the company C. Okay, so the tax amount of rupees 140. What can we do with that? We have to pay this to the revenue authority. So the company B should pay this to revenue authority as part of the income tax installment payment prior to the statutory date as required in the law for such installment payment, right? So suppose the next instance is, suppose the company C decide to distribute the same to another company. Is there any requirement to deduct taxes? No, because it is considered to be exempt as it has already been taxed in the hands of company B. But this you should specifically note, but the expense component has to be identified and deducted before further distribution. That deduction of expenses is required in the law under a specific section. So here the identified expense of rupees 60 by the company B has to be deducted before the subsequent distribution. So for the better understanding, let's work on the next illustration as well. I have another illustration. Okay, so in this illustration, I have there's a small difference, right? Let's go in detail. In this illustration, we have company A planning to distribute a dividend of rupees 1,200 to company B, and the method of distribution is entirely out of profits of the company A. Then in the books of B, as I told you earlier, they record an income of rupees 1,200 as dividend income. So the second scenario is the company B distributes dividends of rupees 2,000 by using both methods. Earlier one, they use only one method. Here, they are going to use both methods. That is by using their own profits, and they are planning to use whatever the dividends they receive from company as well. So this is the most common instance actually in practical terms. This is what's happening in all the corporate world. So the companies generally use both methods to distribute dividends. And also as I explained earlier, and also the expenditure of rupees 2,000 has been identified the company B as incurred in earning such dividend income. All right. So our question is, what would be the tax implication for the shareholders of company B? Right, that's the question. So to resolve this matter, let's quantify the exempt component and the liable component of such dividend income. You also can join and try working on this illustration with me. So let's start the working. Based on the information, we can quantify the two methods, like in the total distribution of company B, the total distribution of company B was rupees 2,000. Dividend of rupees 1,200 considered as distribution out of dividend received, and dividend of rupees 800 goes out of their own profits. So in the case of dividend income of rupees 1,200, which was received from company A, as explained in my previous slides, we can compute the gain and profits of such income by deducting the expense of rupees 200, and then we can arrive the tax payable amount by applying the tax rate of 14%. So based on this calculation, the company B can distribute only rupees 860 as dividend to its shareholders. That is, out of the dividend income received from the company of rupees 1,200, they can distribute only 860. the company B could distribute only, the dividend of rupees 860 is it's considered to be exempt in the hands of the shareholder of the company B. So then the balance distribution, 2000 minus 860, that is the balance distribution of rupees 100,140 is considered to be liable in the hands of the shareholder of the company B. So, okay, right. So with are you all clear up to this point? I can, any question from those two illustrations?
Yes, there are some questions lined up. Just to make clear, it was Zara's question that in illustration, the previous illustration, there was a reduction of 260 as an expense on dividends. Just to make clear that these expense relate to the distribution of dividends.
No, these the expenses, based on the definition, we can distribute only the profits and gain. To arrive the profit of the dividend income you got, we have to law specifically ask you to deduct expenses, whatever the attributable expenses in arriving that income. So the 200, the expense deduction is required under the law.
There's another question. Do you want to continue?
No, what I wanted to add, yes, no, what I wanted to add was, so when you deduct expenses, as the definition says, you have to deduct expenses. So you need to identify expenses which are related to that dividend income and then deduct it. So if you don't deduct any expenses, you have to have a case if the revenue does question as to why there was no expenses identified in relation to that investment income. So that's the idea. So
that is required under the law. Actually, you have to identify.
You have to identify. So what they say is, if you have business income and investment income, and generally dividend income is considered to be investment income, in your P&L you will have expenses. So what they say is, attribute anything that is relevant to the investment income and deduct it, and then you distribute only the net amount. So that's the principle. In practicality, there are companies who say there is no expense, so they distribute the whole amount. Yeah.
But the argument can be disputed, no, Roshini, because the revenue authority can always come back and say it's provided in the law. So if you're earning some income, there should be the expenses. There should be an expense attributable to earn that income.
Yes, so that's correct.
It can be challenged. Yeah.
Yeah.
And I can see a question: can a company use combination of both dividend received and profits earned by them to distribute dividend? Yes, that's what I was referring to the illustration too. And I didn't get why she got exemption. I'm not very clear on what is that illustration he's referring to. That's all right. Yeah. Then shall I move on to my next session?
Are there any questions? Because we can even take any questions if they have before we go into the other exemptions.
Roshini, there's a question. Can you define dividends again? And who is liable to pay tax? The company or the shareholder? If so, why do BOI get exempted?
So, do you want me to take that question?
Yes, he's asking about the definition, Roshini. Regarding the BOI thing, I think we gave the answer.
So the definition of the dividend is given in the. It can be in various forms. Jivani, can you go into that?
Yeah.
So if you really look at it, it can be in various forms. It can, a dividend can arise if there is a share buyback. If there is a reconstruction, if there is a reconstruction of, if you are a group company, if there is a reconstruction of your group, there might be instances where, a dividend can arise. So that's why the definition, you cannot purely go on what is in the company law, but it's defined quite broadly. So it's difficult for me to go through every single scenario. So other than a distribution of profits, you'll have to go through certain transactions, see whether a dividend will arise for income tax purposes, right? So what was the next part of it, Jivan? So who is liable to pay tax? So as I said at the start, the provisions of withholding tax on dividends was abolished from January 1st, 2020. So if a company is distributing dividends out of their own profits, there is no withholding. The shareholder will have to bear the will have to discharge the tax. So if company A is distributing to company B will have to discharge the tax. So there is no obligation on the part of company A to withhold. But then, but if company A is distributing out of their own profits and part of what they have earned, then you will have to see whether on the pass-through, whether tax has been withheld. That is where the complication can arise when you have pass-through dividends, to see whether tax has been deducted. So you need to, when you get a dividend warrant from a company, you need to see what is the source, whether it's from profits or pass-through. Depending on that only, the tax has to be discharged. Okay. What is the next one on that, Jim?
That's all. There's another question to there's another question to how much extent the maximum amount company can expense out from dividend received. That depends actually.
Yeah,
that depends. There is no framework in the act. There is no guidance in the act to quantify that amount. So that depends. In most cases, companies are attributing expenses based on the revenue, or that depends. That depends on the company's criteria and all. And there's another
So just to add to that, if there are general expenses, there have been instances where the revenue can come and say, okay, prorate certain, percentage as well. Yeah. So there is no, like Jivanti said, there is no a maximum or a minimum that the revenue laws say that you need to deduct. What they say is what is attributable to that income only you need to deduct. So you need to, so that is very subjective. So the company can say, for example, deduct 10 rupees, the revenue might come and say, no, it's, an X amount, So it's if the revenue questions only, you will have to say, prove that this is only the expenses that were incurred to earn that investment income.
Yes, there's another question, sir. Can you give some example directly identifiable to investment expense? I would say to
it can be borrowing cost.
Salary. It can be borrowing cost. The first thing,
It can be borrowing cost.
Yeah, as well as part of the salaries who are managing the funds as an overhead cost. Those can be directly identifiable to the investment expense.
So if you are having a substantial sort of an investment portfolio and you have dedicated staff, it's not only the staff expenses who are managing, but also that the general overhead also they can ask, to attribute to these investments. Yeah. So it can be a combination. There are no specific other than the borrowing cost, or if you have some or advisor that is helping you with your investment portfolio, which are directly attributable. Others can be very general common overheads which you might have to attribute.
That's all, Roshini. The questions,
Okay, all right.
I'll move on to the next chapter then. Okay. So with that, I will quickly move on to the next chapter, that is the other important exemptions on dividends provided in the tax law in Sri Lanka. So first one is the exemptions granted for the dividend income which was received by a resident company through a pass-through distribution. If I read out the section, it says the dividend paid by a resident company to a member to the extent that dividend payment is attributable to or derived from another dividend received by the resident company or another resident company that was subject to withholding under section 84. So this is specifically pertaining to the dividends received out of pass-through distribution, but the first distribution was made prior to January 1st, 2020. So prior to January 1st, 2020, we had the withholding mechanism, but that is no more applicable here. So as I described in my earlier explanation, the distribution prior to January 1st, 2020 was always subject to withholding tax. And because of that, no further tax is required on such distribution. So based on this principle, the Inland Revenue Act provides the exemption on such dividend income, right? So the next exemption is granted to the dividend income received by a non-resident person. If a non-resident person is receiving a dividend income, such income is exempt from tax. On the other hand, if that non-resident person is distributing dividends out of such exempt dividends, then such dividend income is again exempt from the tax in the hands of recipient. So the next exemption is the next item. The next exemption is granted to a dividend income received by a resident person from a non-resident person based on the ownership criteria. So this section says if such resident person has a substantial participation in the non-resident company, then the exemption is provided on the dividend income received from that non-resident company. The term substantial participation is specifically defined in the Inland Revenue Act, and also this exemption covers both dividend income and the gain on realization of shares, right? Then the next item is about the exemption on foreign dividends received from a foreign source. But such foreign source has to be identified as exempt based on the provisions in the Act, right? Based on the list of the exemptions granted for the profits and income in the Act, there's a specific exemption granted for the foreign source income. And if such exemption is applicable, then the dividend received out of such foreign source is also exempt from tax. Okay, since this exception is important, I consider this exemption is very important. So let's see the next illustration to understand how we should deal with foreign dividend, which is exempt from income tax. Okay, so this is the next illustration. So in this illustration, we have company A planning to distribute dividends out of the dividend received by them. But here the company is a non-resident company, so they distribute dividend out of the exempt dividend they receive. So again, as we discussed in the books of company B, they record an income of ₹1,000, right? So do they have any tax exposure on such income? I mean, the company B has, do the company B has any tax exposure on such income? No, because the company B has no requirement to deduct taxes on such income, as in the dividend warrant they receive from company A, this shows as exempt dividend. So however, suppose company B wants to declare a dividend distribution of ₹2,000 and they are planning to utilize the dividend income received from company as well, A as well. So then what is the tax implications to the shareholders of company B under that scenario? So based on this, again, we need to quantify the profits and gains which the company B can distribute out of the dividend income they receive from the company A. So applying the same principle we discussed in our prior illustrations, the gain of ₹800 is computed. You can see my working here, computed as the company B has identified ₹200 as expenses, which can be attributed to the exempt dividends they receive, right? So then based on the same, the company B can distribute only rupees 800 as pass-through distribution, which is again exempt in the hands of shareholders of company B. And rupees 1,200 goes as payable dividend. So that's the tax implication of the shareholders when you get a foreign dividend which is exempt, right? So we'll quickly move on to the other two exemptions in the list. So the other one is the other exemption. The next item is the next exemption is given to certain business undertakings which are in accordance with the certain provisions of the Finance Act in Sri Lanka, as well as the businesses which have entered into the agreement with the BOI. So the list of I'll get you the list of businesses qualify for these exemptions. So these are the list of businesses qualify for these exemptions. So when such companies declare dividends, then that dividend is exempt in the hands of recipients, right? And then the last exemption is a dividend paid by an enterprise which has entered into an agreement with the Board of Investment of Sri Lanka that we have already discussed under Section 17 of Board of Investment of Sri Lanka prior to April 2018. So this one actually the exemption is coming through the transitional provisions. So I think in our next sessions we will next income tax sessions they will probably describe what is the transitional provision and everything. So those BOI companies, if those BOI companies are still enjoying the tax exemption under the same agreement, then if they declare dividend, such dividend is exempt from in the hands of the recipient. So I think with this, I'm concluding my session. But before I hand over the session to Roshini, one more thing I need to highlight, that is here in this forum, we have discussed all important and fundamental theories of dividend tax based on the prevailing law. But there can be specific scenarios where a separate and comprehensive analysis is required. And also those issues should be taken case by case basis, as sometimes those issues are specific to a particular business case, right? So anyway, whatever the analysis you are going to perform should be based on the fundamentals we discuss here, including the specific inclusion to the dividend definition, for example, share transfer issues, share buyback transactions, etc., etc. So the fundamental theories we discussed in this session are very important for you all to understand or resolve those complicated matters. Okay, so I'm handing over the session to Roshini. She will wrap up the session. Over to you, Roshini. Thank you.
Thank you, Jeevanti. So just to sort of summarize the couple of items that she has sort of enumerated, the first thing that you need to do is to identify if when you're distributing dividends, whether there is a specific exemption on the dividend. Right? Second one would be to identify if there is a pass-through. The third one is you need to identify due to sort of a very particular, sort of a transaction, whether dividend has arisen because of that transaction. Because based on all of those scenarios, how you discharge the tax would be different. Because when you do distribute, it can be a combination of from exempt, from pass-through, and from your own profits. So it is very important to identify on what basis the company has distributed, because all that will get disclosed in the dividend warrant. And then thereafter, the tax also, if any, the company that is distributing has to be discharged at the agreed times as well. So that is sort of a very concise, summarized version of what Jeevanti has been explaining, sort of emphasizing the importance of identifying what the source of the dividend is. Because if you don't, you might end up either paying tax when the dividend is exempt or not paying the 14% when it should be. So in both instances, it can be a challenge to the company and to the shareholder as well, because the shareholder also will discharge a tax based on what is given in the warrant. So to conclude, Jivan, do you want to show what a warrant is generally, what companies use?
Yeah, just to go through the format, no, Roshini.
Yeah. So this warrant is basically more legal document than for tax purposes. It also has all the tax clauses. I'm not very sure whether you can see all the clauses, but the clauses will say on what basis the dividends have been distributed and how the tax has been discharged. So this is what in Sri Lanka, this is what the shareholder will use if and when they have to discharge, because like I said, you don't want to pay tax on dividends if it has been discharged correctly, and vice versa. So it's very important that those items are identified and correctly shown in the warrant, because the warrant becomes like a final document, you know. And this is what the department also will sort of go through if there is an audit to see whether the tax has been discharged correctly. So that sort of concludes in what we sort of want to speak on tax on dividends in Sri Lanka. Are there any questions that you want to ask before we wrap up today? Are there any final questions?
There's a question from Denuki. It primarily relates to the exemptions, and she wants to know what is the difference, or rather, can you explain the difference between the 0.5 and 0.6? What is the difference between these 2 points in the exemptions side?
Okay. Jivan, do you want to take it? Yes. Yes.
Point 0.5 and 0.6.
Yeah, the last two items. She wants to know the difference.
All right. Okay. Now the difference is the item 6. Item 6 actually these are the agreements entered with the Board of Investment of Sri Lanka under the section 17 of the Board of Investment law. But the item 5, they have not specifically mentioned. There is no requirement to get the tax exemption under the Board of Investment law, because after, as Roshni said, after 2000, if I'm not mistaken, Roshni, it is after 2014, right? After 2014, Board of Investment, they don't grant the tax exemption to the companies. What they do is in the agreement, they refer to the particular section in the Indian Revenue Act, and they give sort of a confirmation saying you are within the conditions given in the Act. So the item 6 is the exemption coming from the transitional gazette, and the item 5 is specifically, it's limited to specific business undertaking. So those are the differences between the item 5 and 6. Roshni, you want to add anything on that?
Yes, so on the 0.6, these can be agreements that were signed before the income tax, this new income tax law came into effect, which was April 1st, 2018. So there is a specific transitional gazette which gives permission, to put it very simply, to claim those exemptions if the exemptions are continuing up to that point. On 0.5, these are on specific industries. So that's the difference. So you can still be a under 6, you can still be a Board of Investment approved company, but you may not be enjoying the tax holidays. So that's that possibility is there. Firoz, are there any more questions?
Yes, there's a last question. Can you explain conditions on which a company can get BOI exemptions?
Yes. So shall I take that, Jivanti?
Yeah, Roshni. Yeah. Okay.
Yeah, so BOI, like I said before, Board of Investment is actually is the regulatory body which governs foreign direct investment. So depending on the type of project, only the concessions are given. I think it's 2011 or 2013, I'm not very sure. The Board of Investment was asked not to give income tax exemption, so it was referred to the income tax law. So in terms of income tax, whatever the exemptions that are in the inland revenue or the income tax law, you can enjoy if there is any. But then there are other concessions which the BOI can give, like customs, exchange control. So it all depends on the size of the investment you're going to make and the approval, because the approval process can be quite lengthy because you have to put up a proposal and you need to show the investment that is coming to the country and so forth. So generally, that's how it's the investment and the type of the industry you're going to invest in is what they really look at. So you need to put up an investment proposal paper and go through that and show where you're going to construct the project. There's a lot of, paperwork that needs to be done. And the approval process also can be lengthy. So basically, that's how it works, the BOI. But generally, on principle, it's to attract foreign direct investment to the country. I hope
Okay,
that
Roshni.
is clear. Yeah. Are there any more questions?
Okay, last question from the same participant. Can an exporting company get BOI exemptions? A company which exports, can they get a BOI exemption?
I mean, it depends. It has to demonstrate investment into the country. So that is key. So if that is possible, they may be able to put up a proposal for BOI, but you'll also need to evaluate what are the concessions, because if I compare the concessions that were there, say 20 years ago, which I think most of the apparel companies, had the benefit of enjoying, they don't have it at the same scale now. So you need to evaluate and see, because the process is, like I said, can be quite lengthy. So you need to evaluate and see, depending on what the proposal is, what sort of concessions, because there are various regulations which governs depending on the investment size. So you will have to either speak to the Board of Investment first and see whether there is a possibility of seeking assistance for concessions. But for income tax, there are the Board of Investment generally does not give exemptions now. So if you want visa requirements, like I said, there might be other requirements to run the business, like visas for foreign nationals, operating accounts, so forth, getting licenses. There might be concessions in that line. And customs. There is a customs. There's a customs deferment scheme for BOI companies. So that is also possible. But you can also, if you are an exporting company, and you're importing, there are other schemes as well, which is governed by. You don't have to go to BOI. You can go to customs that are like TEEP, which you can make use of. It's a similar. The way it operates is similar, but you don't have to be approved BOI. So you can look at that as well. Any other questions?
Yeah, we just got two more questions. Zara Azam wants to know, is there any exempt dividend band amount for individuals?
For individuals,
is there a threshold that is exempt for individuals from dividend taxation?
No, so there are two things. So if it's a foreign dividend, if it's for an individual under the foreign source, they may be able to claim the exemption. But generally, for individual is paying tax, no, so you'll have to, I think it's 3 million for the year exemption. So you can fall under that and then pay on the slabs, which is 6, 8, 6, 12, and 18, I think.
So there is no particular threshold for dividend income.
No, there is no particular one.
No particular threshold.
Yeah, dividend, like as an individual line item, there isn't. Other than the foreign source, if it's a foreign source, they can claim a Jeevan.
Yeah, another foreign source. Yeah.
Yeah, it's that sort of foreign dividend if an individual has invested.
Yeah. Is there any other question?
I think that's all
Yes.
from the question side.
Can we then wrap up?
Yes.
Yeah. Okay. If there are no further questions.
Yes.
Yes.
There aren't any questions. We can just wrap it up.
Okay. Thank you so much.
Thank you so much, Roshni. Thank you so much, Javanti, for your precious time. It was quite a comprehensive but important subject.
Thank you so much. Thank you, ACC, and we look forward to the next session, which is on transfer pricing from a local context, which is on Thursday.
Yeah.
Thank you.
Yes.
Thank you again,
Thank you
and have a good evening, everyone.
Thank you.
Thank you so
very
much.
Thank you. Thank you.
Take care. Bye-bye.
Bye.